So today we're looking at our intro to cost and management accounting. And under this topic, basically what we want to cover is we want to look at the nature and the scope of cost accounting and management accounting, right? We want to discuss the similarities and differences between cost accounting, management accounting, which is very, very similar, and really difference with financial accounting. That's what we would have covered in Unit 1. Basically, the financial accounting, the main aim of that is to develop the financial reports, which you would not only provide for internal users, but external users as well, right? We'd identify the limitations of management accounting. We'd look at costs, different types of costs, and we distinguish them in terms of their behavior. And more specifically, this entire thing usually looks at more of the manufacturing account, so the schedule of goods manufactured is what the term that they'll use to describe it. So let's get into it. So management accounting or managerial accounting is basically speaking about the same thing, right? What is it really, right? So management accounting, the focus here is on basically accounting tools that managers can use internally to run a business. So it's more for the internal users as opposed to the external users. And for this reason, it doesn't lend itself to those strict rules that you would find in financial reporting, where you have to adhere to certain types of formats and certain types of what's the other thing for, the objectives and basically the format. With the financial reporting, they try to standardize the way in which income statements are done, and the way in which they present the reports should be the same across the board. For management accounting, because it's for internal use, right? The way in which they may do it varies from company to company. It's more developed to suit the needs of the management, because it's ready to help them control their day-to-day operations. And it works well when you look at it historically. So you would usually compare performance of actual results with what they budgeted to happen. And you could do this over a period of time as well too, right? To see how the company is performing. So management accounting, it varies from the financial accounting because the intended purpose is really to help the internal users, as I mentioned before. And it's to help them to make more or better well-informed decisions, right? And this usually has to do with production, maybe making a particular product, pulling a particular product from its production line, probably outsourcing some parts of the entire production process to another firm or something like that, making what we call sometimes make or buy decisions. Should they make something or buy it and then sell it over? These are the kind of decisions that management accounting is going to help management or the internal users management make. Cost accounting now. So cost accounting is a form of managerial accounting, right? So it's like a subset of managerial accounting. And the aim here really looks at helping the company capture the total cost of production. You see, with the cost of production, as you would see as we continue, involves different types of costs. When I say different types of costs, some costs are fixed, meaning that there's one fixed thing regardless of the amount of units produced, right? And then there are other costs that are variable, meaning that these costs increase or decrease based on the level of production. So cost accounting looks at all of the input costs that is associated with production, including both the fixed costs that I mentioned as well as the variable costs. So cost accounting, just like management accounting, is used internally by management and helps them to make informed business decisions. So it usually provides information about your day-to-day control of operations. It gives or indicates information such as inefficiencies, wastage of materials. It analyzes like losses from plant and machinery breakdown when plant and machinery is not working. What cost is involved in that? Variable costs might not be incurred during that period, but there may be fixed costs that will still be incurred whether or not the plant or machinery is operational. And then the other thing it does is it compares actual to estimated or standard costs. So usually managerial accountants, they would have actual costs and what they may have estimated, or they may have a standard for the cost. and they always look at the difference between these two. And the difference is usually referred to as a variance, and the variance can either be positive or negative, depending on which is greater, right? So that's how they actually check for inefficiencies, right? If we budgeted cost for something to be X amount, and then the actual cost was less, then that's a good variance, right? If it isn't, then it's a bad variance. So cost accounting, let's look at a short video explainer, right? That is going to give us the meaning, definition, and explanation of cost accounting, which, unlike your financial accounting, which provides information for external stakeholders, cost accounting basically is for internal users. So it's not required to adhere to those standards. So it's flexible, very flexible. It's flexible to meet the needs of your management. So let's take a look at the little video. For some reason, this is not playing. 1 second, let's check that. All right, so we'll just talk about the financial accounting. Basically, as you already know, the financial accounting, the main point of focus there is on preparing financial statements and records. And these are prepared with adherence to specific standards. So it's there to meet the needs of external users, so governments, lending agencies, investors, potential lenders like the bank I mentioned before, right? They're the ones that are going to be interested in financial accounting, which is the statements, the financial statements that we would present at the end of a period. Now, there are similarities between financial and management accounting. They're both used for decision making. The stakeholders that look at these two different types of accounting, they are using this information to make more informed decisions. They're both going to use the same source documents. So all of our day-to-day transactions, things like your stock card and inventory and your receipts and your receivables and your payables, all of these things feed into these different branches of accounting. Most of the elements in the financial accounting are also found in management accounting. So elements such as planning, controlling, decision-making, organizing, and directing, they are all present in management accounting as well. The differences, which is an important thing for you to know, they love to ask questions about the differences between financial accounting and managerial accounting. So the best way to approach this is to look at it based on some criteria, right? These are the criteria that I would be using here to base or to examine the differences. And they include users. So who are the users of financial accounting versus who are the users of managerial accounting? And we reiterated that quite a number of times already. External users for financial, mainly internal users for managerial. The time focus. The focus of financial accounting is a very historical perspective. You guys would have covered that already in Unit 1. You're always looking back into the past to prepare the statements. But managerial accounting, because we do things like budgeting and stuff like that, we are looking at more of a future emphasis, right? We want to kind of anticipate the production cost that we may incur over a period of time. And then when it actually happens, you look at it to see if there was a difference or variance between it. The verifiability versus relevance. Well, for financial accounting, the emphasis is on verifiability. You want to make sure that the information that you are presenting can be verified and is reliable, right? But managerial accounting, the emphasis is on relevance, right? It has to be relevant for planning and control because that's the main purpose of managerial accounting, to assist with planning and control. Where precision versus timeline or timeliness, is concerned, the emphasis is on precision for accounting, financial accounting. Whereas with managerial accounting, the emphasis is on timeliness, right? The primary focus is the whole organization for financial accounting. Managerial accounting, the focus is more on segments of the organization. Very often you'd see the segments has to do a lot with your production area. Requirements, where we know that financial accounting has to follow certain standards, and these are usually the gap on the prescribed formats. With managerial accounting, there's no need to follow any gap or prescribed formats. Basically, it's to meet the needs of the managers, so they could decide on how they want it done as they see best fit and in terms of how usable it is. So we want to get into the main thing for managerial accounting here, which is, we look a lot at the manufacturing accounts, right? Or the schedule of goods manufactured, because a lot of the businesses that we would look at here under managerial accounting usually have some sort of manufacturing element involved, right? They're either making some type of product to sell, or they're buying the product and selling it to people. So let's look at it. Now, as you go into manufacturing costs and managerial accounting at large, what we're going to focus a lot on is on costs. So this first video explainer is going to look at the different types of manufacturing costs, those that you would know already, and then we look at some others. Now, I want you to, as you go through these, we're going to be looking at different ways of viewing cost, right? And when I talk about cost, I'm talking about like expenses. So it's not to say that a particular cost, we could group one cost under different headings. So you'd see here something that might be direct material, direct labor, manufacturing overhead, and this might fall under the category of prime costs or conversion costs. And then later on, you might see where we may refer to it as something as a product cost, right? So it's just different titles or different, they could be classified differently, but that doesn't mean that if one course is prime course, that's all it is, and that's the only thing it could be, right? So pay attention to that as you go through. So let's take a look at this first video. Just make sure.
So when we talk about managerial accounting or cost accounting, something that's going to come up pretty frequently is this notion of manufacturing costs. So when we think about manufacturing costs, they're very important because they're actually going to be used in calculating something called cost of goods sold. And so it's important that we have a fundamental understanding of what manufacturing costs are. So when we think about manufacturing costs, I'll just abbreviate here, manufacturing costs can be split into three main items. So we've got direct materials, direct labor, and manufacturing overhead. And I'm sure you've heard the term overhead before. You might not have an understanding of what it is, and we're going to talk about that in the video right now. So let's use an example. Let's take a firm, and let's say that your firm, let's say that you manufacture automobiles. So you make cars. That's what your firm does. You make cars. Okay, so we're just going to use an example as we walk through direct materials, direct labor, and overhead, and kind of tie it back into this idea of making cars so you can understand and it's a little bit less abstract. So let's think about direct materials. Now, if we want to define direct materials, what we're really doing is just saying on a broad level, it's any kind of material that goes into the final product. So when we can think about our example for the cars, so an example is going to be steel, right? Steel is going to go into the car, right? The car is going to be made of steel. We might have something like rubber to make the tires. We have these different things. Maybe you have plastic to make a windshield wiper on the car. You have all these different things. They're direct materials, and they directly go into the final product, which in this case is the car. So they go into the car. If it's somehow some type of material that actually is put into the car to build the car, then it's a direct material. Now we've got the second component now, which is direct labor. And when we think about direct labor, it's kind of similar, a little more abstract, but it's labor that can be traced to that car. to individual units of production, which in this case is the car. When we talk about tracing, what we're talking about is we can say, okay, well, look, we can actually tie a specific person, so some laborer, some employee at the firm, we can tie them to this car. So we just had a car come off the assembly line, and we could say that this person helped assemble that car. They put the door on. They did something that we can trace it, and we can say, okay, this labor from this person went into that car, and that's kind of this idea of tracing. Now you might say, well, in what case could you not trace something back to the car? Well, if we think about someone like, for example, a janitor. So a janitor, we can't necessarily tie the work the janitor did sweeping the floor to an individual car. We can't really make that leap. It's not traceable, so that's not going to be direct labor. So direct labor would be more like the person who's doing the assembling. And kind of the idea of the janitor not being able to trace the cost is going to lead us in to basically the idea of manufacturing overhead. And manufacturing overhead is just generically everything that's not direct materials or direct labor is overhead. So I'll just give some kind of specific examples so you'll understand a little bit better. So when we think about the indirect labor, we've got, of course, I just gave the example of the janitor. Indirect materials might be a little bit more difficult to understand. Maybe there's some glue or something that was somehow used to put together something that in turn then was put into the car or something like that. It's some kind of thing that doesn't really it's not really like steel to be used for the car. If we just think about something, like I said, like they're using a glue gun in the factory to put together, let's say, your rear view mirror. So let's say there's glue to put together a component. So I guess in a way you could technically say that maybe the glue is an input to the car, but not really. Really, it's just something that's kind of used somewhere along the line. It's this tiny thing that is kind of indirectly used to build the car, but it's not real. You wouldn't say that car is made of glue. At least I hope you're not driving a vehicle that shoddy. But when we think about other kind of costs that really can't be traced, we can think about things like utility costs, maybe depreciation expense, maintenance and repair for a machine that was used to assemble the vehicle, things even maybe like property taxes. Right? We can't really trace property taxes directly to a single vehicle that comes off the assembly line. So really, when we think about our three types of manufacturing costs, it's really this idea of tracing or being able to figure out if these things actually go into the car or some way measure and figure that they go into the car is really what is going to be the determining factor of whether something is overhead or whether it's not. So we've got direct materials, just material, the steel to build the car. We've got the labor, the assembly of the car, the person who put the car together, and then really we've got everything else, which is our overhead.
All right. So this kind of distinguish between three of the main types of costs that we'll be seeing inside of the manufacturing account, right? You guys are familiar with this. This is not new to you. So there's your manufacturing cost, which includes your direct materials, your direct labor, and your manufacturing overhead. We know that all of these combine together to give us our prime cost as well. All right. Let's move on. So generally for managerial accounting, a lot of the types of accounts or businesses we'll be looking at here usually involve some sort of manufacturing process. And manufacturing speaks to the conversion of raw materials into a finished product. And this is done through the efforts of workers and the use of production equipment, technology, right? And well, obviously your raw materials. So we saw that the components of your manufacturing cost included your direct materials. And these are all materials that form an integral part in a finished product, right? And the easiest way or how we could identify them is if they could be traced very easily to the finished product. So in our example, when we talk about the cars, they talk about the steel, they talk about maybe the wires, the lights. These things are materials that are going to be traced back to the vehicle. If we're looking at making a chair, we're talking about the seat, the back, the frame of the chair. With direct materials do not include minor items like glue, varnish, and nails. Very important for you to remember that. It's in there, but it's not actually, you know, the main thing in actually making a product. Direct labor, when we talk about direct labor, we're talking about the wages of the personnel who work directly on the goods, right? So the assembly line workers in an assembly line or factory, they will be considered direct labor. Machine operators, counter attendants in a fast food outlet. The supervisor for the machine operators, that would not be direct labor. Rather, that would be indirect labor. The manufacturing overheads now includes all the other costs of production except your direct materials and direct labor. So this is indirect materials like the glue that we mentioned and the nails, indirect labor, right, which might be the janitors working in the warehouse, the heat and light, property taxes, depreciation inside of the manufacturing plant or the factory, right? Those would be a manufacturing overheads. As I mentioned before, costs could be labeled different things, right? So if something is a let's say a direct material or direct labor, it could still fall under the category as one of the prime costs. Your prime costs are all the direct costs. Conversion cost is the cost of changing raw materials into finished goods or semi-finished goods. So, for example, both direct labor is going to be considered a prime cost and part of conversion cost as well. Please understand what is the point I'm trying to make there, right? So your conversion cost would be your direct labor and all other manufacturing overheads. Your non-manufacturing costs would be like your marketing and selling and distribution costs. So these are the costs that are necessary to secure your customers' orders and actually get the finished product from us to the customer. So this would include things like advertising, shipping, sales, traveling, sales commission, and then we have the administrative costs. So these are all the organizational or clerical costs or executive costs that is associated with running the business entity. So general accounting expenses, secretarial services, public relations, even transport to some extent, right, would be considered an administrative cost, traveling expenses for your traveling agents. So we talk about the manufacturing account and the different types of account there. But we could also classify costs by function, right? So we could identify some costs as those that relate to stock valuation and income determination purposes, right? So for stock valuation, we have to distinguish between what we call product costs and period costs. Product costs are assigned to the inventory in your balance sheet, whereas period costs are expenses that we will usually treat with inside of our income statement. Right, let's take a look at a short video comparing product costs versus period costs.
In this video, we're going to talk about the difference between product costs and period costs. So this distinction between product costs and period costs only makes sense for manufacturers, retailers, or any company that has inventory. And it's really a matter of timing. When is a cost going to be expensed? So product costs are costs that are assigned to the company's inventory account. So they're going to go to the balance sheet. They're not going to immediately be expensed. So if we take a manufacturer, we're talking about costs like direct materials, direct labor, manufacturing overhead. These are all manufacturing costs. In manufacturing costs are product costs. They're going to be assigned to the company's inventory account. They're going to be capitalized. They're going to show up on the balance sheet. But when that manufacturer actually sells the inventory, then it is going to expense all these costs through cost of goods sold. A retailer, conversely, when they purchase inventory from a manufacturer, they're going to have an asset account called inventory, and that is capitalized, all those costs of acquiring the inventory. But when the retailer sells the inventory to a customer, that's when they're going to expense those costs through cost of goods sold. Period costs are just costs that are not product costs. It's all the other costs, and they are expensed when they're incurred. An example would be selling, general, and administrative expense. So let's say you have sales commission. Okay, that's an example of a selling expense. You just when in the period when you incur the sales commission, that's when you expense it. It doesn't become part of the company's inventory account or anything like that. So let's get in a little more depth with an example. We'll say we're doing a manufacturer. Let's say the company Tesla. Okay, Tesla is a manufacturer. Okay, so we're going to use them. And remember, I said any manufacturing cost is going to be considered a product cost: direct materials, direct labor, and manufacturing overhead. But let's get into some specifics. Let's do a couple examples. So if we have, let's say, the wages, so whatever we're paying to a janitor, the question is, okay, is that going to be a product or a period cost for Tesla? If there's a janitor and they're paying them, let's say $15, $20 an hour to do some cleaning. Well, it depends. It depends. What are they cleaning? If the janitor is cleaning the factory, okay, anything related to the factory is where the production is done, right? That's where Tesla produces vehicles, batteries, and so forth. So any wages related to janitor cleaning the factory, that is going to be considered a product cost, okay? Specifically, that's going to be manufacturing overhead. So whatever they pay the janitor, let's say they pay the janitor $400, okay, that is actually going to become part of inventory. So that's going to become part of inventory for Tesla, and then it's going to get attached to the inventory, and then when the inventory is sold, it's going to be expensed through cost of goods sold. Now, same company, Tesla, let's say, a manufacturer, and we've got a janitor who is cleaning the marketing department. Okay, if they're cleaning the marketing department, that is going to be a period cost. Even though Tesla is a manufacturer, its marketing department is not involved with manufacturing the product. Okay, so these costs of paying the janitor, if you pay the janitor $400 for some work related to cleaning the marketing department or the accounting office or HR, something like that, it's not a manufacturing cost. It's not related to the factory or manufacturing the product, so it's going to be a period cost. So this $400 is not going to go to inventory. You're just going to expense it and just say, okay, wages expense and so forth. Another example would be if we have at Tesla a production manager, and let's say that they're getting paid $100,000 a year. So that salary is going to be a product cost. Okay, this is a product cost because they are the production manager. They're in charge of overseeing production. This obviously has to do with manufacturing. Okay, so this cost is going to end up in inventory. It's going to get attached to the products. That's why product costs are also called inventoriable costs. And then eventually, when the product is sold, it's going to go to cost of goods sold. But if we're talking about the salary, so again, same company, Tesla, manufacturer, we're talking about a salary of $100,000 paid to an accounting manager at Tesla, then we say, okay, you know what, that's going to be a period cost. Even though Tesla is a manufacturer, still performing accounting services for Tesla, that is not a manufacturing related function. So this accounting manager, their salary, when we owe them the $100,000 and stuff, we're just going to expense that in the period that it's incurred. It's not going to become attached to inventory or go through cost of goods sold.
All right. So do you guys understand the difference between period and product cost now? Is that clear? It's up for you.
Yes,
Yes.
sir.
Right. So the product cost, right, we could pass it through inventory because it's related to manufacturing. And period costs are those that are incurred, right? And we have to write off against our income statement. Good. Okay, moving on. Right, so product costs, known as inventoriable costs, they relate to the making of products and providing of services that generate revenue for the firm, right? So these costs goes directly into inventory. So your product costs are your direct materials, your direct labor, and your manufacturing overheads. They are written off when the related inventory is sold. And when we sell the related inventory, that cost that it goes into, that is absorbed. Well, I don't want to use the word absorb, but it goes into your cost of goods sold. The period costs are non-inventoriable costs, so they relate to the business's daily operating expenses, like selling and admin expenses or selling and general admin expenses. So these non-inventoriable costs, they are deducted as expenses during the reporting period in which they incurred. So they are written off as they incurred. And they include things like your marketing and selling and distributing expenses and your administrative expenses. Now, cost by behavior. So there we talk about product cost and period cost. And again, as I keep reiterating, different costs could be classified or deemed. So for example, direct costs and direct labor, we could say are prime costs, but they're also product costs. Agree?
Yes, sir.
Right. That's the point I'm going to make. And now that we're going to talk about cost by behavior, right? We could say that direct materials is a variable cost. Our cost of direct materials is variable because it changes with the number of units that I make. If we are talking about TVs and there's some material, let's say the power cord. If I make more TVs, then I'm going to have to get more power cords. It's a variable cost. But at the same time, that same power cord might be considered the direct material, right? In terms of the making of a monitor, right? Just trying to be as generic as possible here, right? And at that same time too, apart from being direct material, is also part of prime cost and is also a product cost, right? So costs could fall under different umbrellas. So you need to understand what the definitions are for the different type of costs, right? And be able to relate cost items to them. So cost behavior. So cost can be fixed, variable, semi-variable. Another word for semi-variable is mixed, right? There could be a semi-fixed or what we call a step cost. A step cost works within a particular range. So a good example of that is like with your electricity bill. So within a particular amount of wattage, you will pay how much ever dollars and cents per kilowatt. And then if you go beyond that now, it changes. The same thing happens for your water bill, right? If you have you see a parent's water bill, look on the back of it, and you'd see the rates. There's traceable costs, there's avoidable costs or relevant costs. There's unavoidable costs or irrelevant costs, and there's sunk costs. So let's take a look at some of these. So the first one we want to look at is our fixed costs, variable costs, and what we call mixed costs or semi-variable costs. And again, I'll use a video explainer to look at these, right, with the examples.
In this video, we're going to talk about the concept of mixed costs. So we've discussed previously about fixed costs, and we've talked about variable costs and how these costs behave when there are changes in the activity level, like we produce more units at our firm and so forth. And with fixed costs, we're basically saying that our cost is just going to remain constant. It's going to remain the same regardless of how many units that we produce, right? We produce 1,000 units, we produce 500, the cost is going to remain constant. It's going to remain fixed. When we think about variable costs, they're actually increasing. So just plot this out. They're increasing as we produce more units. As the activity level changes, the cost goes up. Now with mixed cost, I'm just going to briefly sketch this out for you. So we've got components of both fixed and variable costs, right? So sometimes people actually call mixed costs semi-variable costs. And the way that they behave is we basically got a fixed component, let's say right here, right? So instead of starting at 0 and going out, we're actually going to start right here, and then now here. So basically, here's our costs, let's say, and then here's our activity level. And so our cost is going to be some amount that's not 0, right? So this is the fixed component, is right here. That's the fixed component. But then as we have a change in activity level, we're going to go up. So it's actually easier if we just walk through an example. It'll make it a little easier for you to understand. So let's say that we have a school district, right? So we've got an elementary school, and they've got a fleet of buses to transport the kids to and from school. So there's going to be some element of maintenance involved in terms of keeping that bus fleet up and running. Right now, when we think about the bus maintenance costs, we can actually kind of parse this into two different components. One we could think about is, well, we're going to need some kind of mechanic. Right? So we hire a mechanic, and let's say that we pay this mechanic $40,000 a year salary. So $40,000 salary. And then in addition to this, though, we don't just need a mechanic. We're actually going to need things like spare parts, right? So let's say that the engine goes bad on one of these buses and the mechanic needs to replace it. Well, we're going to need another engine. So when we think about things like an engine, a water pump, different things that could go wrong on this bus, those spare parts are actually going to vary with the amount of problems that we have with the buses, right? If we have 5 buses that need an engine, then we're going to need 5 engines. Whereas the number of mechanic, we just got this one mechanic, right? So the one mechanic is going to handle the whole fleet. So this is really the fixed component, right? So this is a fixed component of our bus maintenance cost, right? That's just going to remain constant. That's going to be that base level of 40,000 no matter what. But we're going to have a variable cost with regard to spare parts, right? Because if we don't have any buses break down, then this part would be 0. But if we have a ton of buses break down, we're actually going to see the amount of spare part costs going up as the number of buses break down. So if we wanted to plot this out here briefly, let me just change colors. So now if we look at our axes, and then we'll have up here is our cost, and then here is our activity level. And with activity, we're thinking about the number of buses that break down and basically our bus maintenance cost. So we're gonna start right here, and then we're gonna go up. And right here, what this is going to be is that's going to be that 40,000 that we're paying to this mechanic, right? So that mechanic is going to get the 40,000 no matter what happens with how many buses break down. This is the fixed component of this cost, of this bus maintenance cost. The fixed component is $40,000. But the variable component is right here, right? As the number of buses that break down increases, we're actually going to have more and more bus maintenance cost. And so it's going to be increasing. It's going to be increasing with the number of buses that break down. Now, it's not always easy for us to parse out and say, okay, well, what is the fixed component of this mixed cost, and what is the variable cost component of the mixed cost? Right here, we have this as a given, so we know that. But there actually might be multiple things in play here, and it might be kind of difficult for us when we're looking at a mixed cost to determine, what's the fixed cost component, what's the variable cost component. So we actually have a couple different ways of doing that. One is we can use regression analysis, and then another way is using something called the high-low method, which we're going to talk about in our upcoming.
Right, so that's a different type of cost behavior there. And it's important for you to understand how to interpret the graphs, especially for the mixed costs, where you have the cost not starting from the 0 line, but from a particular amount. So in that particular example, it's 40,000. So 40,000 is fixed, regardless of whether they fix any buses or not. You have to pay that salary. Yeah. Let's go on. So you also need to talk about stepped variable costs. So this literally looks at variable costs within a particular range, right? So let's take a look at that video.
In this video, we're going to discuss step variable costs. So when we normally think about a variable cost, if we were to plot it out, we think of that the cost is actually increasing as the level of activity increases. So as we produce more units, the cost goes up. When we think of fixed costs, we think that basically the cost is fixed, it's set, irrespective of how many units we actually produce. It's just that cost is fixed. And so step variable costs are interesting in that they're variable, but they also kind of have a small element of that fixed component within a certain range. And it's best just to illustrate this with an example. So let's say that you run an adventure company, and what you do is you actually take people out whitewater rafting. So they go whitewater rafting, but you need a guide. You need some kind of professional guide to be with the customers to make sure that they don't get injured. And you have this rule of thumb where you say, okay, one guide could safely manage up to 5 customers. We don't want to give one guide 30 different customers and say you're responsible for 30 people. That's just too much responsibility. We say, okay, each guide can handle up to 5, and beyond that, we're going to have to hire another guide. So now, when we're thinking about how the costs would work, we think, okay, well, first let's look at the activity. Let's see we have 4 people sign up. We'll call them customers. So 4 customers sign up and say they want to do a whitewater rafting trip. Well, that means we hire one guide, right? Because one guide can handle up to 5 customers. Well, what if we get an additional person sign up? Let's say now we have a 5th customer, right? So now we have an additional customer signing up, right? But we still just need one guide. So that's weird. It's kind of like, okay, well, we think about this as a variable cost, but we've increased the number of customers from 4 to 5, and we still just need one guide. So in a sense, within this kind of 5 customer range, this is kind of a fixed cost. It's not changing as the number of customers increase. But oh, hey, wait a minute. Now we have a 6th customer sign up for this, and now we need a second guide. Now we have to hire 2 guides. So now it is behaving like a variable cost in the sense that we had an additional customer sign up and we had to hire another guide. So step variable costs look a little weird when you go ahead and graph them out, but you'll see why they get the name step variable cost. So if we think about the number of guides plotted here and the number of customers plotted on this axis, now we'd say, okay, well, if we have anywhere of 5, so this is 0 here, so anywhere between 0 and 5 customers, we're just going to need one guide. So how's that going to look? It's going to look like that, right? But once we go beyond 5, between like 5 and 10, now we need a second guide, right? So now we're going to have here. But in this range, we just need 2 guides. Whether we have 8 customers, 7 customers, we just need 2. But now when we get beyond 10, we get to the 11th customer, now we have to hire a 3rd guide, and so on. When we get beyond 15, now we have to have a 4th guide. And so you look and you see this actually looks like we have steps here. So within each step, if we just look at this step right here, within this little range, the cost behaves kind of like a fixed cost, right? Whether there's 17 or 18 customers, we're still going to need this amount of guides, 4. But it is jumping. We look here. So the activity is jumping. So we can't say, even though within this range it kind of behaves like a fixed cost, when we look in general, we say that as we increase the number of customers, we're going to increase the number of guides that we need. It's just kind of happening in this weird step fashion, which is why we call it step variable cost.
All right, guys, so we continuing. So that was our step variable cost. And as you can see, the cost is variable, right? But then it changes as the activity level changes. With our example here, as the number of customers increased, right? For example, with the 4 customers, 1 guide was capable of doing it. But as you moved further and further away from that number 4, then you required another guide. So it's variable, but then it's in steps, right? So you call it a step variable cost, right? So moving on. So now we're going to talk about that schedule of cost of goods manufactured, or what you would traditionally call a manufacturing account. So basically the heading is still the same. So we have the name of the company to the top, and then we here, instead of with manufacturing account, you put schedule of cost of goods manufactured, and then the reporting period for the year ended 31st of December, or if it's the 30th of June, what have you. The format remains pretty much the same. So you begin with your direct or raw materials, right? There's a calculation for your raw materials, which is ultimately the raw materials used in production. And this is found by taking our opening raw materials, adding to that the purchased raw materials, which gives us our raw materials here available for use. Then we will subtract our closing inventory of raw materials, and that gives us the raw materials used in production. All familiar stuff. So our calculation for raw materials used in production, we will then add direct labor. The sum of these two is what gives us our prime cost, right? So our prime cost will add manufacturing overheads. Usually we would list them individually here and put the entire total. We list all on this second column and then add them up, find the sum, and then take it into our total column. To that figure, as you would already know, you're then going to add your beginning work in progress, subtract your ending work in progress, and the figure that remains gives us the cost of goods manufactured, right? Cost of goods manufactured. The cost of goods manufactured is then transferred to income statement. The income statement format hasn't changed. Again, you will list the name of the company. You would state what the financial statement is, which is your income statement for the period 31st of December, blah, blah, blah. You begin with your sales, right? Now you would work out whatever your adjusted sales figure is. So any changes to sales will be made, and then we will put in the adjusted sales figure here. For cost of goods sold, you begin with your finished goods inventory, right, which is your opening finished goods inventory. We will add to it our cost of goods manufactured, right? And following that, we will get our goods available for sale. After that happens, we will subtract our ending finished goods or closing finished goods. That gives us, when subtracted away from our sales figure, right, the amount that we'll be subtracting from our sales figure, which is the right? The result of this is our cost of goods sold figure. And we know that cost of goods sold from sales is going to give us our gross profit. This is the section where we will be then putting our period costs, right? Salesman salary, advertising expenses, admin expenses, and subtract that from gross profit, right? To leave us with our net income. And that's pretty much what the income statement or complete income statement would look like. Yeah? Any questions so far?
So I good. Thanks.
You good? Gabby, how about you? Any questions? Or you all right so far?
I'm good.
Okay, good. Nice. Right. So that kind of brings us to the end of our cost and management accounting section. Right. What I have for you guys now, if you don't have any questions, is a short activity.